High-frequency trading firms are the black boxes of global finance. Among them, Jane Street stands out as a ghost, a proprietary quantitative trading firm built on intense mathematics and absolute silence. Operating out of New York, London, and Hong Kong, the firm does not employ a formal CEO. It is run by a committee of partners and a fleet of algorithms that generated over $20 billion in net trading revenue last year. Their culture is defined by a low profile. They avoid the press, keep their positions confidential, and meticulously stay clear of the spotlight used by global financial regulators. That invisibility is a primary competitive advantage, a silence the firm maintained until they decided to break their own rules in court. In April 2024, Jane Street filed suit in a Manhattan federal courthouse against two of its former traders, who had left for a rival hedge fund. The firm alleged the pair stole a highly classified options trading strategy. Court filings revealed this single mathematical model had generated over $1 billion in profits in the Indian market in 2023 alone. To prove the strategy was a proprietary trade secret, Jane Street was legally required to document its specific mechanics in public court filings. Those unsealed documents reached Mumbai, where the Securities and Exchange Board of India, or SEBI, began reviewing the exact steps Jane Street used to extract $1 billion from local markets. The attempt to punish two employees in New York provided foreign regulators with a manual on how the firm's most lucrative machine actually functioned. The Indian financial market is a global outlier. Nearly 80% of the world's options contracts are traded here on a daily basis. The ecosystem is populated by millions of retail day traders seeking highly leveraged short-term payouts. These traders focus on index options, which expire weekly and settle in pure cash. The final payout is tied directly to the closing price of the underlying stocks at the end of the trading day. This high-volume, cash-settled environment created a structural vulnerability. For a quantitative algorithm, it offered a predictable path to influence final settlement prices. SEBI's forensic audit of the court filings identified a mechanized two-part routine they called the two-patch playbook. The morning phase involves aggressive buying of Bank Nifty stocks. By routing orders through a local subsidiary to bypass rules, this volume pushed the index up, encouraging retail traders to follow. Simultaneously, the algorithm builds a massive short position, betting the index will decline. The algorithm treats these morning stock purchases as a cost of doing business, an expenditure required to reach the elevated levels where retail options traders become the counterparties for the firm's hidden short bets. The strategy concludes in the final hour of trade, just as the weekly options are about to expire. The algorithm systematically offloads the massive basket of stocks it purchased that morning. This sudden, large-scale sell-off forces the underlying stock market to decline rapidly. Jane Street accepts a controlled loss on the stock sales to ensure a crash. Because the index options are cash-settled, the firm collects astronomical profits on their short positions. On a single expiry day, they turned an $8 million loss in stocks into a $90 million profit in options. The firm avoided automated detection by unwinding the entire sequence within the same day. Because exchanges typically check position limits only after the closing bell, the algorithm completed its trades before any compliance flags were triggered. The mechanics of the playbook effectively moved wealth from millions of retail traders to the firm, resulting in over $1 billion in profit for the year. SEBI responded to these findings with a 105-page order. They characterized the trades as a coordinated scheme to distort market levels for profit. The regulator banned Jane Street from the market, froze their bank accounts, and impounded over $566 million in gains. Following the regulatory crackdown in India, Jane Street abruptly moved to settle the original New York trade secret lawsuit against its former employees. The decision to sue two ex-traders over their intellectual property eventually led to the loss of a massive revenue stream and a $500 million penalty. The unsealed documentation from the India trades has provided a reference point for other ongoing legal challenges involving Jane Street's algorithmic execution. In the United States, a lawsuit regarding the $40 billion collapse of Terraform Labs alleges the firm used non-public information to front-run trades, accelerating the depegging of the Terra USD stablecoin. A separate federal lawsuit in New York accuses firms including Jane Street and Citadel of using algorithms to engineer zero markers, artificial price voids that manipulate volatility in the American stock market. While these firms state their algorithms provide essential liquidity to the market, the forensic analysis by regulators suggests these systems often function to manufacture the very volatility they profit from. In 2 years, Jane Street reported over $4 billion in net profits from the Indian market alone. These legal and regulatory cases highlight how high-frequency algorithms can convert structural market vulnerabilities into predictable, massive revenue streams for those with sufficient scale.